to welcome everybody here to a topic on governance, executive compensation, and excessive risk in the financial services industry. You could put a exclamation point at the end of the title, and that would be helpful as well. This is, I think, a really wonderful topic and a great partnership between the business school and Friedrich-Ebert-Stiftung. I don't know, did I butcher that badly? Yeah, my German is not, my wife were here, she might be able to do slightly better than I would on this. But I think it's a wonderful partnership on a topic that is, as we say, both timely and very important. So I wanted to thank Werner and Friedrich-Ebert-Stiftung for all of their work in co-organizing this, and also to thank Bruce Kogut from the Sanford Bernstein Center for Leadership and Ethics, who kind of come together to put together a really great program today. And also I know Sandra Navali, who's sitting up here at the front, who's done a lot of hard work in putting the program together. So I know we're all very excited to hear the panelists and kind of get a sense of really very different perspectives on the crisis. And I think this is an important topic, even though we've seen a financial reform bill that is still hard to figure out what we're going to see coming out of Washington. That's really, I think, the beginning, not the end of the story in terms of what's going to happen in the future. I think it's going to be very important, both for academic and policy researchers, to really think about and try and disentangle what's happened in the crisis. Because whatever the government's going to do, it's going to be important for private institutions and governments to continue to work together to try and understand and move forward to prevent what happened in recent years from happening again. So I look forward to the comments today. I think all of us do, but since we have a heavy program, I'm just going to move along and introduce Bruce and Werner, who can tell you a little more about what we're doing. And again, I wanted to thank you both very much for a really wonderful partnership.
Well, good morning to all of you. My name is Werner Puschra. I'm the director of the Friedrich-Ebert-Stiftung New York office. For those of you who do not know what the Friedrich-Ebert-Stiftung is, it is a German foundation and one of the so-called political foundations in Germany. Political means that we do provide consultancy services, advice to political decision makers, and our target group and our background is mainly social democratic, the Social Democratic Party and the labor movement and trade unions in Germany. So this is our background. The office here of the Friedrich-Ebert-Stiftung in New York has a very specific mandate, namely to deal with the multilateral organizations and policy processes in the US. So we work very closely with the United Nations, and some representatives of the member states are here today. And we also work with the IMF and the World Bank in Washington on several issues. And our partners are NGOs, trade unions, civil society organizations, academic institutions dealing with those issues. And we have two main topical areas we deal with. One is economic and social policy, and the other one is peace and security. So these, just as a short introduction. Friedrich-Ebert-Stiftung exists already since 1925, so it's by far the oldest institution of that kind in Germany. And we have extended now our work towards the rest of the world as well since the 50s, after the Second World War. So we have now around 100 offices worldwide, many of those in developing countries, emerging markets, but also, as I said, here in the US, in New York, also in Washington and in Europe. So this is a short background of our institution and of our work. So coming to the topic now, as Chris already had said, it is, from my point of view as well, a very timely topic which we have chosen together with Bruce and the Columbia Business School, because what we can see is that the financial markets are in disarray again, I would say. Governments are now challenged because of the high debts they ran into when responding to the crisis through huge stimulus and rescue packages. When we met first with Bruce and the others in March, I think it was, it seemed at that time that the crisis was almost over. But now the crisis is, the crisis feeling is back in full swing. Policy responses are discussed in Europe and in the US, but not yet in a very coordinated way. So yesterday, Timothy Geithner was in Germany. I don't know what the result of his discussions was, but obviously, he tries a lot to coordinate global responses to the present situation and the present crisis. And governments also have to look into means and ways how to avoid the next crisis of a similar or even bigger magnitude. But not only governments are highly concerned. People around the world who have lost their jobs, their homes, their savings, their old age pensions now fear they would have to pay again and more through either higher taxation or through public expenditure cuts in education, health services, unemployment benefits, and other social services. They do not only expect that those who are responsible for the crisis also do contribute their share to help solving it, they also want to see their governments taking effective steps to rein in the market and transform the financial sector again into what it should be, a stable and reliable intermediary helping to channel savings into productive investments and thus contribute to growth and new job creation. Stronger and more effective regulation of the financial markets is one part of the solution. But what about the internal incentive structures in banks and other financial institutions? Did those structures also contribute to wrong decisions and to excessive short-term risk-taking against long-term gains? Are huge bonuses executives are getting justified? Should governments also regulate pay? These questions were taken up by the G20 leaders in London and Pittsburgh when they adopted principles for sound compensation practices and implementation standards and commissioned the Financial Stability Board to monitor the progress towards those principles through a peer review process. The next G20 summit takes place in a month's time in Toronto, end of June, and receives the Financial Stability Board's review on compensation. It will also receive the IMF report on a fair and substantial contribution by the financial sector toward paying for any burden associated with government's interventions to repair the banking system. This is the official title of this report. So this event really comes at the right time to address those issues, and we are very happy to have representatives from a number of countries around the table to contribute their specific views and perspectives on the issues at stake. And hopefully this event can also contribute to focusing the debate on these issues and overcome some of the rifts which exist between different schools of thought, different political cultures, and different institutional setups. And last but not least, I want to thank the Columbia Business School for having entered into a partnership with us in planning and organizing this event. I mean, this is the first joint venture we have entered into, but I'm already looking forward to the next ones. And I want to especially thank Bruce and Patrick and Sandra and Emily over there for their excellent cooperation. And I would also like to thank my own staff, Sarah and Jennifer and Alex, who contributed their share to make this event happen and possible. So thank you very much, and I wish all of us a very productive and fruitful debate during the day. Thank you.
So thank you very much for coming here. Thank you, Werner, for your kind comments. We too had a great experience working with the Stiftung for this. And it's a bit unusual because at the business school, we have conferences regularly, and we have a debate within our sphere, usually, of our competence and our larger alumni group and the business community. What's been exciting about this working with the Stiftung is actually to have so many people who often don't come to these conferences, be they international institutions or from labor, and I think that's quite exciting for us. So particularly for that, I would like to thank the Stiftung. We're running a little bit short in time, so I'm going to be a little bit quicker than I planned, but I want to make sure we have the full time allotted to our key speaker. So we'll make adjustments along the way. This is a fairly intimate room here, so you're so close to each other. I suggest you keep an eye on your wallets and your keys as you see during the day, and what gives us a chance to talk across these aisles easily. So let's make sure we have time for the program and for the speakers themselves. Let me just say a few words on this very rapidly. We are very honored as a Center for Ethics and Leadership here to be part of the business school and to have the support of the Dean's Office. Chris Mayer spoke here earlier, and also of the alumni. There's sometimes the question of whether or not ethics has anything to do with the financial crisis. I think this is only a question really among business schools, to be honest with you, because the rest of the world pretty much thinks there was a problem with the somewhere along this chain of transactions, whether it's mortgage origination or something else. There's also the issue of compensation on this, and probably compensation is where we get to have the greatest controversy on this. Whether or not there was an ethical problem, is the level too high? I think Werner used the word whether it's justified. These are really tough words for us in business schools actually to decide upon. Usually what we can decide upon is whether or not pay produces good things or bad things. And that's largely what we're looking at today. I don't want to lose sight of these larger questions, but as Werner said, we're really trying to look today at whether or not the governance systems which we had in place, the governance of our banking institutions, whether or not our compensation policies, whether they are responsible for taking on too much risk, not only just doing their job of watching risk, but taking on too much risk, and thereby responsible for the catastrophe which faces us. I had some graphs which we all have seen before, so I won't show it to you. It just shows you what happened to banking assets over the past few years. And let me just say they go up a lot, and then they go down a lot. That's what basically how they look alike. So there's clearly a problem. And also if you look at compensation, level-wise, it is quite substantial. But more importantly, we all know that in terms of the structure of compensation, the use of equity-linked incentives was extremely common in the financial industry, as it is everywhere in the U.S. industry, and also increasingly so in Europe and among European banks, including German banks. So the questions which we face today are primarily twofold, and one of them is to look at the issues of governance. Did governance lead to a failure of risk management, and maybe an encouragement for taking on too risk and therefore responsible for the crisis? And then secondly, this issue of compensation. What has been the impact of compensation upon what many of us would call excessive risk? And I forecast we're going to have some debate whether or not we actually believe in excessive risk. I want to just give a slight forecast of what we might see during the course of the day, and then I'll introduce our speaker. First of all, I'd like to thank someone who was not mentioned earlier, and that's Hamid Mehran from the New York Fed. New York Fed is playing an important role in the economy, and it's also playing an important intellectual role in the people who were able to come here today, and Hamid is the critical person for this, so I'd like to thank him for helping us so much here. So I was thinking about various people, what they're going to say. So I know Harold Howe is going to say something about state-owned banks in Germany lead to bad performance, and that the boards of these banks were less experienced as well. Hamid Mehran is going to argue that big boards, oddly enough, lead to better governance. And Hamid, I can't see you directly, but I think this is probably good news given that the Treasury is now probably the biggest financial institution in the country, It certainly has the biggest board as well. Patrick Bolton is going to talk to the dangers of equity-linked pay during financial bubbles. Lucien Bebchuk, with his work with Holger Spalman, both of them are actually here. We'll talk about the moral hazard of bank holding companies. And then Renee Stoltz is going to maybe say, I don't know, Renee, that Lucien and Holger are absolutely wrong, and that top executives, in fact, she lost a lot of money. I'm just trying to tell you that, among these very nice-looking people, there are arguments and fury about to be released. Sid and I, as well as Josie Shankman, have a little bit less confidence in the benefits of equity-linked pay. I should tell you that that many of our colleagues here at Columbia, and I think historically in finance, believe that equity-linked pay was what's called pay for performance, and that was the way actually to incentivize banks for optimal performance. So it's a bit of a, if you wish, a reversal on these issues. Charlie Carmeris is going to show why everyone is wrong, Charlie. Jack Coffey will show why he is right. And Katrina Pastor, in fact, probably will be right on most of these things. And finally, I think we'll have a great debate from the audience and also the other panelists in terms of the institutional insights. I know that Tano Santos has been very involved in the Spanish situation, so even some of the academics will be bringing us some insights from what they actually have experienced. So with that, I'm going to launch the games, let them begin, and let me turn to introducing our keynote speaker, who we're very happy to have here. Happy to have Susan Bies here for many reasons, and one is that she is a criminal like the rest of us with a PhD and had taught before, and she has a degree from Northwestern University in economics and was plying this trade for a period of time, but quickly left for the private sector, where she worked for a number of banks. And I note here that of the many tasks you had, Dr. Bies, also you were the Executive Vice President of Risk Management and Auditing. So you bring a very deep knowledge of these things as well. She was a member of the Board of Governors of the Federal Reserve System, has deep knowledge of the accounting issues behind this. Also had been part of the CFO committee as well for the financial industry. Recently, she has joined the board of Bank of America and therefore brings a deep knowledge of the current situation, which she may be at partial liberty to discuss with us today, and we would appreciate those insights which she can bring. Dr. Bies, thank you so much for your patience. We give you the full floor and the full allocation of time to start off this conference. Thank you very much.
Well, good morning to everyone. I'm very honored to be here to help start off the day, and we've got some very serious issues to deal with. I hope I'm going to give you some anecdotes that maybe will add a little bit of humanity to some of these issues that are really tearing our country apart, both in the financial system, but also just a lot of the political rhetoric that we're hearing in the United States every day. And I am going to talk from the point of view both of it as an economist, as a former regulator at the Federal Reserve Board, as a former banker, and also now as in my role on boards of directors. And I want to say at the start, these are going to be my comments. These do not necessarily reflect the views of Bank of America or Zurich Financial Services, even though one of the things I am going to talk about is a little contrasting and challenging the approach to risk of the insurance industry versus the banking industry, because I think there's some things there that we can all learn from. The first part of what I want to talk about is some issues when I've been meeting with bankers across the country and other interested folks around the world that I call one of the major issues that I think is the core of the topic of today's agenda. And I call it the Groundhog Day Problem. I don't know how many of you saw the movie that starred Bill Murray, where he was a reporter and was faced with every day waking up, and it was still Groundhog Day, and he had to relive that day over again and over again and over again because he didn't get the message. He didn't know what had to happen. And that's what I think, no matter what scheme we come up with regulatory-wise, or what we talk about in all of this governance issues and risk management, we've got to overcome the groundhog problem. And it's not just in the US, it's globally. But I'm going to use the US as an example. I've been in banking now since the 70s. And in my time, we have been through, this is my third major housing mortgage crisis, the third one. If you look at the root causes that we have in this crisis, one of the things you see is that most of the causes were not new. They were well known, well understood, but the lessons just seem to have been forgotten over time. So what is it that we have forgotten? And let me sort of start by just going down a list of the issues that we saw this time around. What we saw was that, one, we forgot that real estate is a local market. And in doing that, we focused too much, and I'll talk more about these practices as we go along, too much looking at individual loans and underwriting and didn't focus enough on the marketplace. The economists clearly saw that we were building houses in the United States at a pace well beyond the number of new households being formed each year. We basically over-constructed 3 years of housing in the United States. That excess inventory is still with us. And so the cries in Washington to get back quickly to the same pace of real estate sales and mortgages is overlooking the fact that we don't have enough households yet to absorb this tremendous amount of housing that we've got. We also know that what was happening as it went along and people began to see prices continually rising is it created its own demand because we saw investors come into the market to just buy housing to speculate. And I realized in Washington that it was really a problem when my dental hygienist told me one day while she was cleaning my teeth that she had just bought her third condo, all for investment purposes. So all this began to create more demand for housing and more units. In the United States, we had some markets where 40% of new construction went to investors. 40%. Globally, throughout the US, we were seeing housing for investment purposes running 3 times normal on average. That should have also been a warning signal. Now, with all of this unusual pricing, I think one of the things that we heard from Dean last night at dinner I thought was right on the mark. It was based on an appraisal model that was fair market value. I think one of the challenges we've got is to say, is that really the approach we should be using? Or as he suggested, one alternative that looks at valuing property more relative to rents. Heck, we do it when we do the consumer price index. Maybe it's good enough to try to modify appraisals. But appraisal practices tend to make crises bigger because by matching current sales in a neighborhood, you're going to make existing comparables continue to go up after the peak and not pick up what is the unusual movements in that. We also had very low interest rates, and whether it was commercial real estate or development loans, banks were making loans at cap rates that were way below the risk that was inherent in those processes. That was exactly what went on in the 70s. Bankers forgot they needed to know the local market, and so they began to lend outside their footprint. So there were credit unions in North Dakota lending in Florida. They didn't know anything about Florida. It was the same thing that happened in the U.S. in the 70s and in the 80s. Nothing new there. We also saw the return of no documentation loans, where people basically who were originators wanted to close a loan no matter what, and you don't have to provide documentation of your income to get a loan or any other facts about yourself. This was a way to speed up the closure process. Competition got so fierce, people didn't want you to go talk to a competitor for fear you wouldn't get the loan done. We saw the same things in other crises, and we're seeing it again, and we still haven't learned the lesson about this. The banks have been struggling to restructure most of these problem mortgages, and the government has had some programs. One of the issues some of the banks have really been raising in Washington is, we can't restructure these loans unless the borrowers give us proof of income. We don't have it. How can we know if the loan's affordable if they don't tell us their income? It took the Treasury Department until the beginning of this year to agree that, yes, a restructured borrower should have to provide proof of income. I mean, that seems like a no-brainer, but we're still took a long time to persuade people that that should happen. By moving also to a securitization market, which I'll talk a little bit more about, we also began to focus more on collateral value and forgot the basic lesson of credit underwriting that bankers have learned the hard way over the years, that you have to, for the household, base lending first and foremost on ability to repay. You only care about the value of the house if the borrower cannot repay it from their normal cash flow earnings in the house. So it happens when somebody is injured and can no longer work, or if they lose their jobs. You've got a way to get there in unusual circumstances. We turn that in the primary base of lending. And when you have the cycles of contagion in real estate prices, you again make this whole thing worse because you enable people to get into houses that they can't afford. Not just the mortgage payments, but bigger houses have bigger utility bills, more upkeep, more bathrooms, you have more plumbing bills. All your expenses go up when you get into bigger houses, and you just can't afford it. We forgot that lesson again. And again, I think some of the early moves in Washington that didn't focus on the ability to repay wasted time and energy in this respect. Finally, a lot of the credit scoring models that were used by the rating agencies and other securitizers along the way were really based on credit scoring models. Realize many of these loans, again, didn't have income to document. And the credit scoring models in and of themselves, I think everybody believed were more useful than they really were. If you go and look at Fico Scores, all a Fico score is it tells you in a rank ordering, not an absolute ordering, a rank ordering, what's the possibility or the probability that somebody is willing to repay a loan. It doesn't tell you anything about their ability to repay a loan. And so what we saw is not only credit scoring that just looked at a willingness to pay, it didn't look at capacity of the borrower to repay the loan. Again, a cardinal sin of these models. And I think this is something that we're criticizing the rating agencies. We also have to realize, like the commercials on TV, a credit score is nice, but the main message that needs to get into new credit models and enhancements, and I think the industry is a long way ahead on doing this more robustly, is really to go ahead and incorporate the ability to repay a loan and the capacity of the household in general to respond to crisis in cash flow. But the credit scoring model also was used in a way that was not appropriate for many things. We've been through this many times before, so what do we do in a governance sense in one of these banks? How do we, say I'm a board member now, how do I make sure that management has learned these lessons, that they're incorporated into the culture, that we don't repeat it again? And I guess I'm saying I'm very pessimistic about this. The fact that we go through this every decade in the US, that other countries go through it periodically, what do we do about these cycles in the housing industry? We keep forgetting the lessons we learned, and we're going to be condemned, in my Groundhog Day analogy, to basically relive this over and over again. Second point I want to make is the structure of the mortgage industry, and this is really more in the US, but it's, I think, lessons for people in other countries of a direction not to go in. Savings and loans and banks were traditionally the ones who made mortgage loans in the United States. But with the growth of mutual funds and rising interest rates in the 70s, deposit growth slowed dramatically. And depositories weren't getting enough deposit growth to fund loan growth. And that created a need for long-term funding for institutions. And it was about the time that people began to look at securitizing mortgages. What it did is it generated product to put into mutual funds, but it also allowed lending institutions to originate mortgages and sell them off so that they weren't constrained by the rather modest growth they had in deposit gathering. But the model that really took off then was how this all got with Fannie and Freddie in terms of the amount of capital that got to the industry through those agencies. And it enabled loans to be securitized and sold off very rapidly. It met a need in creating liquidity outside of depositories. But the structure that has evolved is one that needs to be looked at. And again, I don't hear much discussion about this. The whole model today is based on transaction compensation. The loan originator only gets paid when they close a loan. The aggregators who pull these loans into securities only get paid if they securitize something. And the investment banks only are going to make money when they're out marketing these securities that are created. Everything is transaction-based. And when you only have transaction-based, you want to get a deal done as fast as you can, as often as you can. And I think it's why we had so many shortcuts in the mortgage origination process. If you look at old-fashioned, good sense lending rules, one of the things that banks who always had good credit records had was that there was no compensation to lending officers that was based on volume of loans originated. The primary driver of compensation in good banks for lending officers was the quality of their portfolio of loans. So what you originated, you had count in your compensation until that loan was paid off. It was part of your portfolio. And if you originate junk, it didn't add anything at the beginning, and down the road as your portfolio deteriorated, you paid the price, including losing your job. We don't have that incentive system in the United States. In fact, one of the challenges is that so many of these mortgage companies, well over 50% of all mortgages are made by companies that aren't part of a financial institution. They're standalone mortgage associations, many of which are mom-and-pop operations who have virtually no capital. So they don't have the sustainability to be around for a long time to manage these long-term portfolio compensation schemes. We have to realize what that is doing to the process. And we also have to look at the tail end, and this is coming up more profound in this crisis than prior because of the number of foreclosed loans that have to be dealt with. What is happening is servicers the people who handle the monthly payments that come every month from people whose mortgages have been securitized basically work and are hired by the investors in those securitizations. The borrower of the original mortgage has no ability to determine who their servicer is. It is totally out of their control. Their mortgage can be sold to anybody tomorrow, and they start doing with somebody else. I analogize this with the problem of the healthcare industry. In the healthcare industry in the United States, one of the issues is generally the employer has the contract with the insurance company, and that's who they deal with. And the average consumer of medical services just goes and does what they want, and they don't care about costs. Servicers, because they work for investors, have priority. And if you remember, there were legal issues initially in all these restructurings about how much they could work with the borrower because they were hired by the investors. But there's no recourse for a servicer or the borrower to go back to the servicer and say, I haven't been treated well, because they can't pick the one who's going to be servicing their loan. They think it's the bank or the mortgage company they borrowed from, but they're out of the equation once that mortgage has been sold. And it's because we do all the securitizations in the United States rather than doing things that the Europeans do, like covered bonds, where the originator keeps the bonds and keeps the customer relationship. And there might be lessons there, I think, from the Europeans we can learn about. But not having a customer relationship after the mortgage closes is a huge issue. And again, I can't find, I've been trying to work through all the pages of the Senate bill, I can't find where this core issue is being addressed anywhere. Now let me talk a little more directly about governance. And this is based on observations of many companies in both my time as a regulator and people interactions I've had recently to see how things are changing. Chief risk officers in the financial industry have different roles. And I'm going to, at the end of this, I want to talk about the insurance industry differently. If you look in the traditional broker-dealer investment banks, their job was to oversight what was going on in the trading desks and underwriting desks. And you worried about risk positions that were being taken. Some organizations do this very well. Goldman has got a superb risk culture all the way through it. Every employee understands it. All the managers follow it, and the board clearly makes sure that it continues. In banking, commercial banks, though, the risk function is still evolving. If you think back, because I was one of the in banking at the time, when the Federal Reserve deregulated deposit interest rates in 1978, it created an asset liability crisis in the financial industry because everybody had these 30-year fixed rate mortgages on the books. And now all of a sudden their cost of deposits weren't fixed anymore. They were going to go up and down with market rates. And so we had to create an asset liability management function. The credit function, in its traditional sense, had always been there was always chief credit officers. But it wasn't until the mid-90s that we began to think about enterprise risk management at financial institutions and including operational risk management in here. Now, if you look at the chief risk officers in companies today in the commercial banking space, many of them still don't have a senior enough position in the organization structure. In many cases, they report through or under the chief financial officer. Sometimes they're aligned with the auditing function, and they have limited exposure to the board of directors, except maybe if the board now has created an enterprise risk management committee. And this has happened in some organizations, it hasn't happened in others. They also don't have, in many organizations, the stature to really say no to the line. And the line officers clearly make make it clear to them that we're the ones that pay your salary because we bring business and revenue into the firm. That's because of the culture within the organization. There's also problems still where risk management is the job of risk managers. That isn't the case. The culture needs to be that risk management is the job of line management, and it's the job of the risk managers to make sure that there are frameworks and validation of the risk appetite and the risk controls. Risk managers who manage risk is a governance scenario doomed to failure. And we have to reinforce that and make people understand the line has got the point on the responsibility. If you look at the board committees, you also still see a lot of issues that are surrounding this management governance problems. Most boards of directors globally have a compensation committee, and they'll have one or two risk committees. When we talk about compensation in the role of this crisis, it's interesting. I'm talking to as many boards as I can. The compensation committee, when they are looking at compensation schemes for the organization, I only have been able to find 2 companies where either it's a joint meeting with the risk committee or the chair of the risk committee of the board actually participates in the discussion. So the implications for risk-taking of compensation schemes is not governed well at the board of directors level. And that's also true in the human resource department. They tend to go and work with the line management to do compensation schemes. They never interact with the risk management department. We're still too siloed in the way we're viewing things, both at the board and at the management level. And one more thing I want to talk about, and this really is something that hit me, the discussion I had with some folks last week and observations I've had being on Zurich Financial's board. When you go into a risk committee of a bank and you use tools like VAR, which the regulators in Basel II is based on VAR, what you're saying is, what's the range of loss you're going to have out to 95% confidence? And the way you think about it is anything beyond that is unlikely. And if it's unlikely, we're not going to spend any time preparing for it. We're going to focus on it, just keeping losses within there. The insurance industry has a whole different approach to risk. Their approach is, we don't know when the next earthquake is coming. We don't know when there could be a firestorm. We don't know when the next windstorms are going to come across Europe. But we know when it happens, we have huge exposures. So they don't look at something in the extreme as something to be ignored. They understand that their main mission is to manage their exposures for those extreme events. So you think back in history, the insurance industry was very active. For example, in the Middle Ages and early centuries of the Industrial Revolution, you used to have whole cities wiped out by fire. What happened is the insurers encouraged everybody to go ahead. Let's strengthen building codes. Let's put space between buildings. Let's create professional firefighting as a critical element of government. You did things that would deal with the fires when they occurred. Look at the losses in Chile versus the losses in Haiti. You had wonderful building codes in Haiti and in Chile so that the loss of life and the damage were minimal considering the much vaster economy that was insured versus Haiti. So the message I'm giving is in the financial services industry, the banking, investment banking world, we have got to stop thinking about the tails as unlikely events and begin to say they are going to happen because of the Groundhog Day effect. And because they're going to happen, we've got to focus more on what do we do to prevent them from happening and what's our immediate reaction to the crisis when they do occur, even if we can't predict when they're going to occur. So I hope that maybe gives a way to think of some of the issues that I know we're going to flesh out in and the rest of today. And again, I thank you for the honor of opening the conference. Thank you very much, Bruce.
I'll make a suggestion. Make the suggestion that the next panel come forward. Susan, please stay there. Okay. So Hamid, maybe come forward. Werner and I will evacuate our spaces here, and we have time for questions. Thank you.
Yes, Jennifer?
So Susan, you ended with this idea that we need to focus on both prevention and the right kind of intervention. You also earlier mentioned the Senate bill. I'm curious what your thoughts are in the U.S. on both the Senate bill or the House bill in terms of whether the prevention and intervention mechanisms are sufficient.
Well, let me say at the beginning, I'm still working through the Senate bill, as I mentioned to you earlier. So my comments, there may be, some of these things may be in there, I just haven't gotten to them yet, because it's quite a lot of reading. I don't believe the prevention side is focusing on the root causes. You know, there's a tremendous amount of attention on derivatives, but derivatives weren't a cause of this problem that we are facing in the United States. AIG had a derivative problem. That was mismanagement at AIG. It was unregulated effectively. You need to deal with those kind of things by focusing on improving regulation. And we do need derivative reform. I mean, I totally support that we need to do clearinghouses and or exchanges for various reasons, including the operational risk of just knowing who your exposure is at a moment in time, and if the regulators have to come in, they at least can see what those exposures are in a clear way. But if you remember last week, and I can't think of the name of the senator who proposed this, someone had proposed that we require that all new mortgages in the United States have a minimum 5% down payment on the house. That was immediately dismissed as outrageous. It'll deny home ownership the American dream if we require 5% down. And I would say one of the reasons Canada tends to do relatively well in these things is they do have a much higher minimum down payment, and the conventional Fannie Freddie loan has a much higher. It's this constant conflict. The fact that none of this is dealing with Fannie and Freddie's role that was Dean again mentioned last night in the way of creating liquidity to fuel the fire once it had already started and we had this fire surge. We need to deal with that. So there's a lot of work. Some reforms probably needed to happen anyway, but I find relatively little addressing a lot of the root causes of this crisis. Again, more than half of the mortgages were originated by entities that have no federal regulator. Yet the state's attorneys generals were very effective in arguing to Congress that we do away with the right of preemption, which says that the controller of the currency can go and examine every part of a national bank and keep the local state folks out of it. This makes sense for multiple reasons, just in terms of management of different rules and regulations. But the AG process is not an effective process like bank supervision. Bank supervision is done in a prudential framework. It's the job of bank regulators to try to anticipate problems and get a bank to address them early. AGs come in with lawsuits after the mortgages have been out, after people have defaults, and you know that there's problems. So it doesn't prevent it. It gets back to my other analogy. Using an AG to create a sound lending framework and consumer protection framework is not the appropriate way to do it. The horse is out of the barn by the time they get into it. And it's sort of, again, this Groundhog Day. We've got to think of a better way to approach it. Yes?
Hi, Susan. Nice to see you again.
Good to see you.
I'm wondering if you've read the Valkowitz report on the Lehman Brothers bankruptcy and what you find of the fact that he was unable to find colorable claims against either management or the board, despite the fact that, you know, the matter was misrepresented to the board, was not included in risk management reports, etc.?
I have only read excerpts of that report. I was spoiled all these years. I've always had assistants to help read this stuff, and it takes a long time. These aren't the most easily reading documents. Let me sort of make a comment on information flow to the board. One of the things I would like to see happen, and I see it now that I've gone on the Bank of America board. The board at Bank of America was like many financial institutions. It grew through mergers over the years. Every time you merged, you picked up some of the legacy directors and added them to your board. Wonderful business people who really took their duty seriously. But the business changed. And you didn't have expertise in some of the critical risk areas sitting on the board. And we saw this, if you remember, with Enron's failure. And Sarbanes-Oxley, one of the things that came out of it and what the New York Stock Exchange had anticipated already in their rules was that you had to have financial expertise on the audit committees. Because just going to the audit committee, if you didn't understand accounting and if you didn't understand audit, were you asking the right questions? I think we need a similar rule for risk committees of boards. That whatever the industry you're in, I mean, let's face it, BP might want to follow this on the risk committee of their board. What are the biggest risks that you are exposed to? And make sure that you have a couple people on your board who can serve on the risk committee, who understand those risks and ask the right questions. And if they look suspicious, have the ability to force the auditors to go in and really look at those areas. Whether they're doing safety audits or whether they're looking to see if the risk exposures are there or the derivative books are kept correctly. If you don't understand the nature of the risk, you don't know what questions to ask. So I think they were well-intentioned people but didn't have the expertise. And we have to step away from the good old boy kind of board memberships and get enough expertise in the risk, at least to staff an effective risk committee of the financial institutions. Okay. Well, thank you, and I look forward to talking to you all the rest of the day.